Do you want to know about Warren Buffett's contrarian investing? Then stick till the end of today's video. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about Warren Buffett's contrarian investing. We're explaining everything, and I'm telling you, I will explain to you what is contrarian investing. Let's just talk about that. Contrarian investing refers to a strategy of investing in which the investors go against the trends that are followed by the majority. So you are going counter the trends. So contrarian investors buy or sell shares when the majority of investors are doing just the opposite. This requires a lot of gut though. So typically what happens is that the investors who engage in contrarian investing do so with a long-term view. So this strategy can be used with stocks, with an entire industry sector, or with bull markets or bear markets. So a bear market occurs when there is a downward trend in the market that lasts for a longer time period than a stock market correction. By contrast, a bear market occurs when the market continues to climb. Now let's talk about some famous contrarian investors here. I mean, I'm sure you know some of them. There are several famous investors who have engaged in the practice of contrarian investing. For example, Warren Buffett, one of the top contrarian investors, very successful. We love this guy. So he says, for example, that the opportune period to invest in a stock occurs when the market trends have caused the price to drop. He says that people should be greedy when others are fearful, and he showed that many times. The last time was in 2008 when he had a huge stake in Goldman Sachs and other top American companies when everybody was just fleeing the scene. Right, so Warren Buffett is fantastic. You also have somebody called David Dreaman. He's a publisher of a contrarian investment strategies. We have read his documents, and he thinks that investors exaggerate because of the influence of media. So this causes popular stocks to be overpriced, while the earnings of lower value stocks are underestimated. So this causes limited upward prices and sharp falls for stocks that are on fire, opening up the opportunity for investors to pick up undervalued stocks to add to their asset class mixes. You also have a great contrarian investor in the name of Michael Burry. He determined that the subprime market was incorrectly priced and overly emotional. So Burry owned Sound Capital, which shorted and profited from the subprime mortgage market rather. So The Big Short, that was written by Michael Lewis and has been made into a movie that documents this contrarian investing move, came from Michael Burry. Let me just kind of give you a few stats about the United States when it comes to contrarian investing. So between 2008, when the financial crisis started, and 2016, the percentage of Americans who were invested in the stock market fell from 62% to 52%. That's a 10-point gap. That's a 10-point delta. So among people who are currently invested in the stock market, 50% have less than $40,000 invested in their asset class mixes. So among people who are not invested in the stock market, 21% say that they do not trust brokers, while 53% state that they do not have money available to invest. So for 90% of US households, a market shift of 10%, which is enough to signal a market correction, their wealth holdings will only have an impact of 1 to 2%. So the point here is that we live in a world where you have newcomers like M1, Robinhood, that are still in, quote unquote, still in traffic away from the old established brokerages. But that's kind of cool. It is cool because they are actually contributing to expand the market. And within those investors, of course, you're going to have contrarian. You're going to have contrarians. You're going to have people who follow the crowd, and that's kind of cool. So when we talk about contrarian, what type of investor is a contrarian? So investors who tend to be contrarian in their investment choices, they tend to thoroughly research the companies and their fundamentals. So the companies that are chosen tend to have solid reputations and stable profit margin. Okay, so the fundamental analysis refers to doing like real research. So you are looking at the financial statements of the company, the balance sheet, the income statements, the statement of cash flow. You look at the ratios. You do some research around the industry, around rivals. So you're really taking your time. So contrarian investing does not follow a bull market or bear market view. They believe that the value of an investment is below its intrinsic value. We will cover the topic of intrinsic value in another show. So as such, contrarian investors view the investment as presenting an opportunity to make a profit. So instead of investing only during bull markets, these types of investors invest whenever a stock is undervalued. What are the contrarian methods we have there? You have several methods that are used for contrarian investing, and Warren Buffett has used a lot of them throughout the last 30, 50 years or 60 years. So contrarian investors typically have strong research skills and choose companies that are heavily financed, are undervalued for the wrong reasons, and have good profit margins. So the price to earning ratio is factored in, but the PE ratio is not the only thing that they look at. So you need to look for stocks that have a low price to earnings ratio or PE ratio. So the price to earnings ratio or PE ratio measures a stock's current price compared to its earnings per share. So the PE ratio is determined by multiplying the share price by the number of fully diluted shares that are outstanding. Next, you need to divide the product by the sum of what the company has earned over the past 4 quarters to determine the price to earnings ratio of the stock. The great thing here is that a lot of financial investment platforms such as the Yahoo Finance, they give you the PE ratio. They just give it to you right away. So when you see the price, when you see the stock's ticker symbol, and when you see the price, you also see underneath you have a lot of ratios that are shown, including the PE ratio. You should identify when movements are exaggerated, which is when they extend past a sensible point. So the market tends to focus on the short term because of overreaction that causes an exaggeration in the amounts of price increases and decreases. So this allows knowledgeable investors to profit. Contrarian investing involves buying when others are selling and selling when others are buying. So think about that. Contrarian investing involves buying when others are selling and selling when others are buying. This is contrarian is kind of similar to contradictory. So that makes sense for contrarians. So contrarians typically purchase low value securities called dogs and sell hot securities that other people want. They do not pay attention to whether the market is a bear or a bull market. So a recession can offer a great opportunity to invest if you are an adept investor who is able to hold a long position and who is able to spot behavioral market trends. So if you're good at identifying a stock that is undervalued but that you expect to boom in the future, you can invest in it. This is called trend investing, and it involves buying a stock before it trends upwards and then riding the trend up before you sell. The major factor in contrarian investing, folks, is you need to determine which stocks to buy and sell after the stocks recover. So the key is taking a long-term view of your investments. So this helps to minimize the impact of the volatility that is caused by short-term market swings. And we've had that recently with the pandemic triggered market volatility. So having defined what a contrarian is and explained to you what it takes to become a contrarian, how do you think like a contrarian? How do you do that? If your goal is to go that route, how do you think like that? And if you want to think like a Warren Buffett, one of the top contrarians out there. So to think like a contrarian, you can do several things. To figure out high volatility periods, you want to look at indices such as the Chicago Board Option Exchange Volatility Index. This is called VIX. Figuring out periods of high volatility that results from the emotional exaggeration of market participants can open up favorable buying opportunities. You also want to find ways to identify high trading volumes, which indicate investor interest and the possibility that a stock is overvalued. So instead of investing in these types of high volume stocks, you want to look for stocks that are undervalued. Another potential indicator of mispricing of a stock is a high level of investor interest. So some indicators that you should look for in stocks when contrarian investing include the following: low price to earnings ratio, low PE ratio, low price to cash flow, low price to book, low price to dividend. So book value, you compare the price, the market price to the book value, and you compare the market price to the dividends growth over time. So the bottom 20% of the market is the focus. So other factors that you should consider include the following: low payout ratio. You want to have a high return on equity. We actually covered the financial ratios in another show, so you might want to double check that. It's great. It was very popular, and so we talked about return on equity, we talked about PE, we talked about other important ratios. So you also want to look at higher than average dividend yield. This is kind of important, especially if you are trying to build a portfolio of dividend stocks. That's very important. And you also want to look at companies that have pre-tax profit margins of a minimum of 8%. 8%. In the case of Warren Buffett, he even goes all the way to 10%, 10 to 11%. But to start with, I think 8% is kind of cool. It's a great benchmark here. So by doing that, you will start to think like a contrarian. You will start paying less attention to the temporary daily market swings, markets yo-yo. You won't care about that anymore because you have a long-term view. So the yo-yo, the temporary yo-yo, doesn't really matter to you. And that's how you have to start thinking. Now, let's talk about pushing the thinking further. As a contrarian investor, at least what the top contrarian investors do, they have a clear strategy. And this strategy is really around 4 main elements. And I'm going to share them with you today. Only four. To be one of the top contrarian investors, like Warren Buffett and Charlie Munger, you want to have 4 things. Number 1, purchase stocks that are rated as a sell. It might sound crazy, but this is contrarian. You want to purchase stocks that are rated as a sell, and you want to hold on to them until their prices improve. When their prices improve, sell them then. You want to sell stocks that have been downgraded by analysts. I mean, we all know that sometimes those Wall Street analysts are not, they don't have, of course, they are experts in their field, but they don't have a magic crystal ball. So you can use your own gut and your own research to say, listen, they're saying they are rating this stock as a sell. I'm gonna buy. So you sell stocks that have been downgraded by analysts, because since these stocks are usually behind the trends of the market, look for expert opinions on the stock before including them in your list. You want, and that's the first thing, purchase stocks that are rated as a sell and hold on to them until their prices improve. Number 1. Number 2, look for short selling. So this occurs when borrowed shares are immediately sold with the intention of purchasing them at a lower price to return them to the lender and profit off of the difference. So this short interest ratio should be used in this analysis. So you have to think about that. Normally, stocks have a rating of 5 or less. This means that you should aim for ratios of 6 or higher. So this is a method that is typically only used by savvy investors. So you want to do a lot of research about that before getting to the nitty-gritty. You want to look for a large institutional interest in which the ownership is more than 65%. That's the third strategy. So the absolute minimum is 50% ownership. So the idea behind this is to have institutional investors driving up the price because they have the money. I'm talking here about asset management firms, pensions, retirement funds, that kind of stuff. And the fourth element here that you need to implement to become one of the top contrarian investors is to be ahead of the financial news. You want to read, you want to do research, you want to anticipate the news. Why? Because once it hits, your opportunity may already have passed, because you're not the only one having access to the news anymore. All right, I'll be right back. But after this, don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation today around Warren Buffett's Contrarian investing, and I'm decoding everything for you. I'm explaining everything for you. If you like the clarity and quality of the content so far, please consider subscribing to our channel and turn on the notification bell so you are informed in real time whenever we drop a new show. And we drop this kind of shows every single day, rain or shine. Rain or shine. Comment below, like, and share. Let's talk about value investing versus contrarian investing, because we hear a lot of people asking those questions. So there are similarities between contrarian investing and value investing. So Warren Buffett engages in value investing, which is an investment strategy in which the stocks that are chosen appear to be trading for less than their intrinsic values. So when investors follow the value investing theory, they try to identify undervalued stocks and then purchase them. So to be a value investor, you want to look for the following things in stocks. So you want to have below average price to book ratios. You want to have lower than average price to earnings ratios or lower PE ratios. You want to have higher than average dividend yields. So the approach that Warren Buffett uses is that the market tends to overreact to financial news. So this causes the stock price movements in the short term to not be related to a company's fundamentals in the long term. So both strategies, contrarian and value, look for undervalued securities based on the investor's rating of the current market trends. So both types of investors look for stock share prices that are lower than the intrinsic value of the company. Speaking about those stocks, let's talk about the dogs of the Dow. So the phrase "dogs of the Dow" originated in 1991 in Michael O'Higgins's book, and the title of that book was "Beating the Dow." So this was a value investing strategy that was created to perform as closely as possible to the Dow. It's a kind of long-term though. It's a long-term conservative dividend strategy that encourages you to invest in the 10 highest dividend yielding blue chip stocks that are listed in the Dow Jones Industrial Average every year. So the Dow Jones Industrial Average, or DJIA, this is an index that tracks 30 large publicly owned companies, and those companies are trading on the New York Stock Exchange and the Nasdaq. So the Dow Jones Industrial Average was created in 1896. Oof, that's more than a century ago. This was created in 1896 by somebody named Charles Dow and Edward Jones. So that's the Dow Jones. So high yield dividend stocks are stocks that pay relatively high dividends and they have relatively low stock prices. So blue chip companies are those that have market valuations of 30 billion or more. They're called large cap. So these companies also have solid growth histories and future potentials and are listed in major market indexes, and they typically pay out dividends. So the dogs of the Dow, that strategy has outperformed the markets for the past 4 to 5 to 6 years and for 7 out of the 10 last years. So if you want to implement that strategy, you want to look at the Dow Jones Industrial Average on the last day of the year. And what you do is you only choose the 10 high yield dividend stocks that are the highest. So in the new year, you want to invest the same dollar amount in each of the stocks on the first trading day of the year. So you always want to keep your original portfolio for the year. So at the beginning of each subsequent year, you repeat the process. That's what the dogs of the Dow strategy is for. So investors add this type of contrarian mindset into their diversified portfolio because they hope to have a growing return that adds value over the long term. Contrarian investing, though, folks, is an investment strategy that might help you to build your wealth faster if you are a savvy investor. Now, let's just kind of summarize Warren Buffett's contrarian investment philosophy here. So despite over 30 years, folks, that's 30 years, 3 decades, since his first televised profile, Warren Buffett still touts a bargain-based philosophy, complete with the occasional quip or baseball analogy. So what he said, he told CNBC not long ago, that was more than 30 years ago. He said, you literally every day have thousands of the major American corporations offered to you. That's what he said back in 1985. And you don't have to make any decisions. There are no called strikes. So if you had invested, say, $10,000 in Berkshire at the start of 1985, you'd now have 2.4 million. Think about that. After 30 years, 35 years, you'd have 2.4 million if you had invested only 10,000. That's the same principle in the S&P 500 will be worth $227,000. So the U.S. stock market has seen remarkable change over the last 35 years between the meteoric rise of low-cost passive investing, algorithmic trading, and the real-time digitization of financial filings. But Wall Street's most revered investors, decades later, is still touting the same advice. He's still saying the same thing. So Warren Buffett, in one of his first televised profiles, he explained a simple method of investing, and that is that he prioritizes an insatiable hunt for bargains, patience, and the occasional baseball analogy. While we were doing research for this show, we actually came across a video of the interview that he had back in the days, 35 years ago, and he said something that really was important for us. It was very compelling for us. Why? He said, in the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily, right? So nothing is forced upon you. You don't have to make any decisions. There are no call strikes in the business. So there may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And that's the cool thing. You retain the liberty, the freedom not to do anything. And you can sit there and watch thousands of pitches, and finally you get one right. There is when you actually strike, and then you swing. If Buffett's advice from PBS's Adam Smith Money World more than 30 years ago rings a bell, it's likely because he's hardly changed his tune over his many profitable years on Wall Street. That's the power of consistency, the power of patience, the power of perseverance, the ability to use a contrarian investment philosophy and just sit there and watch things happen. So Berkshire Hathaway has posted average annual returns of 17.1% since 1985, well ahead of the broader stock markets, 10.5%, including dividends. So if you had invested, as I said earlier, and that's the great thing, and for me, it's just so compelling because I want to repeat it. If you had invested 10 grand in Berkshire Hathaway at the start of 1985, 35 years later, you would have 2.4 million. One of the things I want to talk about here is that you have to understand, and we're talking here about Warren Buffett's contrarian investment philosophy, and I just want to spend some time on what he calls no call strikes. In one part of the 1985 video, Buffett explains that the key to good value investing is about exploiting one's area of competence in determining the real value of a business. In other words, you have to know what you're putting your money into. You need to link your area of expertise to the industry you're buying into. And once you do that, you want to take advantage of your expertise in a group of stocks. If you can do that, you can sometimes find upside opportunities when the market prices the securities below their actual worth. And Warren Buffett, he even said around the year 2000, he will tell investors that different people understand different businesses. And the important thing is to know which ones you do understand and when you are operating within what I call circle of competence. So there are all kinds of things I'm not competent to value. That's what he said. There are a few I'm competent to value. There are all kinds of things I don't know about. And that may be too bad, but why should I know about all of them? So you got to start thinking about that. If you want to be a contrarian investor, you have to have what Warren Buffett calls your circle of competence. You have to develop that. You need to have skills. You have to know certain industries in and out. All right. So the thing here is that you have to understand that if you are doing that, Warren Buffett has done it, and lately in March and April 2020, some people were actually criticizing him because he sold some companies and he sold airline shares, whereas people were saying, well, you should have hung on to them. No, he has his own strategy, and Warren Buffett has inspired legions of value investors across the globe. And his personal investment philosophy has also contributed to his immense wealth of over 80 to 90 billion, according to Forbes. So, though the sum makes him the world's third or fourth or fifth richest person, Buffett has pledged to donate more than 99% of his worth to charitable causes. So, and one thing that really strikes me when I research and analyze Warren Buffett is that he keeps saying you don't need tons of IQ in this business. He's talked about a circle of competence for his success, to boost success, but he also tends to invest in companies with minimal debt, reliable cash flows, and sound management teams. He also told a media expert not long ago that a good investment manager is not necessarily a genius, but someone with a calm disposition. So you don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, where he lives, but you do not have to be able to play three-dimensional chess. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think, right? So another investment the 90-year-old has touted is throughout his career is remembering to think about each holding as proof of ownership. So you are actually an owner. When you buy a company, you have to think as an owner. So if you don't think of yourself as being an owner of this company in real life, why would you buy it in the first place? So if you're making a good investment in a security, it shouldn't bother you if they close the stock market for 5 years, because you know it's a great security. So this is the kind of thinking you have to have as a contrarian investor. All right, folks, this was it for today. I was talking to you about Warren Buffett's contrarian investing, and I hope you enjoyed the conversation. If you do, please consider subscribing to our channel. Turn on the notification bell so you are informed in real time whenever we release a new show. And also like this content, share, and comment below. I will see you next time. But until then, remember, stay marvelous.